Hello, if you've just joined us, you're watching Stockwatch, and join me in the studio this evening are Gerbrand Smit from NeFG and Gary Booysen from Rand Swiss. Please do send along your markets-related questions. You can SMS stock and your question to 33814, or you can email stockwatch@bdtv.co.za. Gary, Gerbrand, nice to have you both in studio with us. Bit of a down day for the markets. Was this to be expected, given that last week was actually really strong, notwithstanding all the uncertainty about that ratings decision? Gerbrand.
Yeah, look, I think probably expected it where the currency is at the moment, because the big industrial rand edges are what's moving this market, and the currency has actually appreciated somewhat against major currencies from Friday's rating decision to now. I think about 60 cents in US dollars. So you probably would have expected some of these big names coming down 1 or 2% today, and that's what happened today.
Yeah. Gary, last week we asked guests consistently on the show to put forward their downgrade-proof stock picks. Have we erred in doing so, given that a lot of people picked the Rainettes or the Capital and Counties or the Mondis and some of the offshore companies, or would now be a good opportunity if they do come back a bit to pick them up?
Well, it's a good question. I think, it depends on your view on whether the downgrade is permanent. I mean, we were just chatting before the show. Does this mean that the downgrade has been avoided, or does it mean that no one really cares and in 6 months we're going to be downgraded anyway? Because up until probably a week before the announcement, I mean, the commentary and everyone sort of, all the research notes that I read saying this downgrade has been priced in. You look at all the different metrics. The banks have come off. The rand is blown out. Financial markets are priced in. Real markets maybe not, but really this is in the price. And then we didn't get a downgrade, and nothing happened. I mean, you got a slightly stronger currency. I mean, and that can possibly be explained by the jobs number in the US anyway, and a weaker dollar. So. Yeah, I don't know. To answer your question, I mean, I don't think so. I think the market's probably stepping back at this stage and saying, okay, we didn't get downgraded here, but if the downgrade is priced into the financial markets, I mean, you don't have downgrade-proof stocks. There's no such thing. It's already in the price.
Oh, don't be such a spoil sport, damn it. Okay, well, let's talk about people's questions, and then maybe we'll discuss Sasol and Telkom, which came out with results today. Sasol's was a trading update and horrifying at that. Why did Woolworths and Barloworld drop so much today? Were these the stocks that, because we've had, for example, the banks having a very good run. Didn't notice Woolworths having a good run, but anything in particular behind today's falls?
No, look, Woolie's been trading between 83 and 90 for the last year or so. It's still in that range, so a lot of volatility. I mean, half of their business is now in Australia, so maybe the currency has something to do with that. And Barloworld also a rand edge, more than what most people has priced in over the last view. We think it's cheap, but it came back about 2 rand a share. So I think still trading at 72.
Gary, have you had a look at either of those?
I didn't really see anything specific on them. I know Woolies picked up a couple of broker downgrades last week as well, which is that's been pulling it down, like everyone says, back to the bottom of that sort of 83 range. But nothing specific that I saw. Yeah, perhaps explained through currency volatility as well.
What about some of the financial stocks? They started off really wobbly today, but the actual financial index as a whole ended positive. So I don't know what you make of that. But the question is, Old Mutual and RMI, are they good shorts right now?
I won't short Old Mutual at the moment. We know of the breakup and it's worth more, etc. So there's a lot of corporate action at the moment. RMI does look a bit expensive, but it's a well-run company and it's been one of the winners over the last few years. It got the outsurance business that's been doing well. MMI came out with better numbers than expected in a trading statement last week. So I won't short it, but I probably won't hold on to them as well. So I'll probably just not have it in my portfolio at the moment if I look at returns in excess of inflation +7 over the next 3 years. But our mutual, we like our mutual. We think they're still going to have decent numbers. And the some of the parts are more worth than what the whole entity is at the moment. They're going to take out a lot of pound costs at head office, etc. So we like it.
Well, not including the CEO's salary at this stage, but maybe that's just to come. Gary, your thoughts about Old Mutual, RMH? Would you be buying them? Would you be selling them?
Again, I think Old Mutual. You can. No, I would probably. I mean, we're holding Old Mutual at the moment, and we were buying it, between 30 36 and 38. So I think, again, I mean, Gerbrand's covered the, the unbundling, which I think, there's going to be significant value unlock. I think we got that, initial spike, the excitement around it, and now it's sort of has settled back. But I mean, we're also seeing, I mean, with other, let's look at the Bidvest unbundling for a second. I mean, when these things actually go through, you do see the value unlock happening there as well. So, on a long-term equity portfolio, I think if you're holding it, I think you should keep on holding it. I think, there's more upside from here. Also, if you compare it to the other insurers, just from a embedded value point of view, it is one of the more attractively priced ones as well. I mean, I've always liked Discovery, but it's just crazy expensive at the moment. So that's why we've shifted our portfolios into Old Mutual. And again, I mean, insurers versus banks, I think you probably are going to see more performance out of the insurers, in my opinion. But these banks are also looking, hey, they're cheap.
Just RMI, I mean, on its merits, so aside from maybe the question of shorting it, do you think they're doing the right things? Because they seem to be on a bit of a mission to build themselves up as they've got kind of fintech businesses that they're looking to expand.
They've got small asset managers that they're looking to expand as well.
And is this the right tack to take?
Yeah, I think they've done quite well over the last few years. I mean, it listed at, I think, 12 Rand a share, and it's now at 42 Rand a share. Probably one of the best performers in that specific index or financial index over the last few years. But I think at a PE of 20, with Discovery in there, which is expensive and embedded value, as Gary said, MMI do look cheap, but they got their own headwinds coming up in the next year or two for themselves. Outsurance probably fully priced at the moment. So it's all down to these new businesses. Are they going to make a big impact against these other three huge investments in their life? And I don't think it's going to be huge. So probably fairly valued to more expensive territory at the moment. But I won't short it. I mean, that's a very scary thing to do with good companies.
The panel's view on Glencore. Now, this is a stock pick of yours. Earlier this year or
now look,
last
we've
year?
actually punted it at 40 and we punted it again at 20. So we're probably neutral at the moment. But we still like it. The owners of the business are managing the business as well. So they got huge chunks of shares themselves. So they partner owners with you if you're an investor. Debt is still a problem, but that looks a bit better after the share price has risen by more than 100% from the lows. Same as Anglo, but we would prefer Glencore to Anglo, although they've already done rights issues, etc. But I think these guys, and if you look at what commodity prices has been doing, slowly grinding up, etc., you can probably hold on to these as well.
Gary, your thoughts? I mean, is Glencore able to move quicker than some of its peers, given that its management is so invested in the company, and then will respond? That I don't know. Is it a consideration?
Can they move quicker? It's I suppose a difficult question. I mean, it's a very different business to the other. I mean, if you're looking at like a Billiton or an Anglo, so I mean, obviously it's got its huge trading component. There's a lot of other things in there, but I think they, again, they have moved fairly quickly, I suppose, relatively speaking, in the downturn in commodities. And I mean, I think they've put the right things in place. I mean, as Gerbrand said, they've done their rights issue. I mean, they've cut their dividend. They're really de-risking and de-gearing the balance sheet, which I think is the right move. I mean, if you look at, I suppose, the commodity cycle in general, I mean, if you look at, I always talk about the commodity clock, at 4 a.m., which is where we sort of think we are now, this is sort of the stage where companies are, cutting down on production, they're cutting dividends, they're doing that, and eventually supply will come out of the market, and when that happens, prices will start to recover, and markets are maybe a little bit more forward-looking, so maybe they recover a bit quicker because people can see that supply is starting to come out, and that really is the buying time for commodities. That's when you want to start getting invested again.
The darkest hour before the dawn.
Exactly.
Is that your 4 a.m. time?
4 a.m. Just
Hopefully we had
before
it
the sun
over the
starts
last
to shine
quarter,
again.
I like it. So as an analogy, it works. Okay, so you would still be buying Glencore?
Yeah, like it's at a price to book of 0.7, so it's still relatively half price to what it's supposed to be long-term wise.
Okay. Is Kumba a buy at the current level?
It's difficult. The iron ore market is probably the one you don't want. But it is probably cheap enough as well to take a punt on it. We're still avoiding the physical iron ore plays because there's still a lot of supply coming on stream in the next year or two. It seems like the big boys are still making lots of money at $30 and $40 a ton, and we're still at 50. So I'm a bit afraid still of iron ore. The others I'm getting a bit more warmer on from a price perspective. But they are cheap. I mean, these shares used to be about 600 Rand a share. It is not as a price to book cheap as what Anglo's and Glencore's and those companies are. Even Sasol is cheaper on a price to book than these guys.
Gary, your thoughts on Kumba?
Yeah, also looking at, I mean, again, Kumba as an iron ore player, I've never thought is a bad one. It's, I mean, its lump is a higher quality than a lot of its competitors, and I mean, it has almost, as much as a fungible commodity like iron ore is, it has a little bit of diversification and it's a little bit less heterogeneous. So, I think in that way, Kumba, is not a decent play if you're looking at. It's not a bad play if you're looking at the iron ore sector specifically. But again, the supply glut is really what's got everyone concerned. I mean, Gina Reinhardt through Roy Hill is still going to bring in massive amounts of iron ore onto the market, and that's significant. I mean, that can easily bring the price back down.
Yeah, I mean, this is Roy Hill's the new Australian mine that she's been working on for
it's
quite a few
and
years.
They are not going to stop
millions of tons.
Yeah.
All right. Should a long-term retail investor practice sector rotation in current markets, or is a well-diversified portfolio worth a buy and hold attitude? Is a well-diversified portfolio with a buy and hold attitude the way to go?
Look, it depends. Most of the well-nice diversified companies in South Africa is probably more expensively priced, the ones that making up the bigger chunk of the all share these days. If you look at more of the SA Inc. type of businesses, they're certainly looking cheap. The Imperials and those type of companies in South Africa and the banks, etc. So you probably need to do some sector rotation, I think, at the moment.
Okay,
for the first time in many years.
So what would you be rotating
for 5
in
years,
and
for
out
5
of?
years, you probably should look at some of the resources and financials to get some holdings into those at the moment, relative to the more expensive Rand hedge industrials. You can even look at some of the local industrials, like an Imperial, which would probably benefit from a stronger Rand, etc., which none of the people that I know is pricing into their models at the moment.
No, they're not. Well, a couple of people are. Gary, would you actively rotate in and out of stocks at this point in time?
Yeah, as a retail investor, I think, I mean, again, you look at what trading costs for retail investors are these days. It's very different to what it was, 5-10 years ago. So I think you can afford to be a little bit more active. And I mean, if you were sitting, 6-7 years ago in resources and didn't practice any sector rotation, you really got punished for it. So I think, going where the value is, where the opportunities are, I think it makes sense. I think, it's definitely worth doing. Okay,
so what will you be selling at this point? I mean, if you could name a few shares that you're actively offloading.
Yeah, it's very similar. I mean, we've been selling, more the sort of, I suppose, the high-priced growth stocks. So things like Woolies. I mean, we've shifted Woolies into Foschini Group just because of the valuations. We've shifted, as I said earlier, we shifted Discovery and Told Mutual. So it's just for us, it's just a process. It's not really a process of rotating out of the sectors. And I think financials at the moment are very, very cheap. So I think a slight overweight bias to financials, I think, is not a bad thing. But it's also just within the sector. There's plenty of opportunities.
Gerbrand, I mean, you mentioned some of the expensive, diversified, industrial shares. So would things like British American Tobacco be? British
American Tobacco, I think, is still okay. But some of the other ones, even Bidvest got a bit of expensive after the breakup at the moment. SAB Miller, and now InBev. There's a lot of them that you can actually sell and buy some cheaper shares at the moment. We think that Imperial is some of those that you can buy. Clover looks interesting. There's a few local companies that we think will benefit from what's going on in the environment at the moment. We like banks as well. We think banks are dirt cheap. We sold some of our RMIs in the last 2 weeks. We swapped them for some of the banks at lower prices. We bought First Rands at 41 Rand a share the other day with our proceeds from that trade. So there's a lot of sector rotations and within the sectors that you can actually do as well. But I mean, if you like sectors, you probably need financials in your portfolio. Big time at the moment. They're the best price. If you've got time on your hand, probably a bit of resources and probably taper down on your Rand hedges a little bit.
Okay.
I'll wait for 6 o'clock on the resources.
We'll leave it there for the moment. So keep sending your questions through to us via SMS and email, and we'll be back shortly.